Today we will talk about XRP, which as of recording is up 183% in a month, and XLM, which is up 442% in a month, and explain why market cap truly is not important, especially for utility crypto. And I have put together some example calculations in order to explain how a relatively small flow of money is actually what is driving price, and how market cap is so incredibly inflated as a result. Chad has been putting out posts on how the inflow versus outflow is actually what's important. Here, he is explaining how 1 million in outflow in a 15-minute period brought down price of XRP by 3 cents. He is beginning to explain the calculations here, except in a different post it appeared as if he was off by about a factor of 10, except I won't hold it against him. I mean, I'm not too concerned about a calculation error. I am just extremely interested in this because I think that it's a really important way to approach things, because we are concentrating on utility crypto that can and will go up in price with regulatory clarity and institutional adoption. And once we get clarity, it could happen relatively fast. And in his example here, once we have clarity and adoption, institutional cash is going to come pouring in. And if we had 1 billion of net inflow in 15 minutes, seeing as how he showed that 40 million increased price by about 10 cents, that would get you to just around $3.80, which is right around all-time high. Here is the same kind of example, except it talks about outflows and shows how a 10 million net outflow dropped price by about 4 cents, which impacted the XRP market cap by almost 2.3 billion, which is the exact point I'm trying to illustrate about how market cap is not actually important at all. XRP futures explode to an all-time high of almost 2.7 billion. And when the futures were this high in the past, the price of XRP went to $2. XRP net flows are flattening out across all exchanges, sustaining $1.47 price with only a little over $1 million. And here is where we will actually talk about the calculation itself. So if we take a 15-minute chart and we pick out any of the periods on there, for example, so in our example, we will look at the period here on November 26th at 00:00. So our open was 14142. 14142, and yes, I talk to myself as I do this, and our close was 14248. Okay, so we've got that in there. Now we need our net low, which is in millions of dollars. So our out is the red value here, so 15,574 in terms of millions, and 5.394 on our in. So our net was about 10.18. $10 million outflow only impacted XRP by about 1/10 of a cent. How about we do another one where it actually increases? So here on November 25th at 1500, we have a start of 13870, 13870, and a close of 13976, 1.3976. Our inflow was 25.987, 25.987, and our outflow, which is the red one, is 5.742. So here in our example, the price of XRP was only impacted by about 1 cent. And in terms of how much price changed per million, it was only about 5/100ths of a cent. And if we take XLM, for example, just type in XLM up here because it'll pull in circulating supply. And let's take this time period here of the 25th at 16:15. So we opened at 0.4988 and we closed at 0.5093. Our in was 5 and our out was 4.357. So with only about $640,000, it was able to increase price of XLM by about 1.2 cents or so. And in terms of the change in price per million of flow, it's about 1.6 cents. So if you look at what the change in the market cap was as a result of that, it was about 315 million, even though it only took $640,000, which implies that the market cap will change 490 million for every 1 million in net flow. So in our example here, if we were to apply that exact same price impact caused by that amount of net flow, we can kind of predict a price. And if we just change the net flow to 1 million, then that results in a 51.5 cent XLM. If we change it to 10, that is 66 cents. In the example he called out, that was trying to explain the potential impact of institutional inflows, he called out $1 billion. So in ours, if we change it to 100 million instead, then that would result in an XLM price of 214. And just for fun, we can type in the equivalent of $1 billion here, and that would take XLM up to 1682, which is probably an extreme example, but the important thing is to show that 1 billion in net flow increased market cap by about $490 billion, which is not a real representation of how much liquidity is actually there. So if we try to apply it on a higher time frame, it works essentially that same way. It's just in terms of a price prediction, the smaller time period it is, then you don't have as large of an opportunity for inaccuracies. On our one-day chart on November 23rd, our open is 0.3398 and our close was 52.18. Our inflow was about 624,670 and our out was 548,372, which meant that on that day the net flow was positive 76 million, which resulted in a 19-cent price increase and about 0.2 of a cent per $1 million, and it had a $5 billion impact on the market cap. So if we apply that same kind of a ratio and we say we are starting at 52.18 and our net is 100 in a day, that would end up at a 76 cent XLM. Let's say 250, $1.11. 500 is 171, and 1 billion in a day would be $2.91. So I don't know that we would see a net of 1 billion in a day. However, it once again explains how even though we only had 1 billion come in, it increased the market cap by about $71.5 billion. So I will be approaching price expectations and even some price predictions in terms of net flow. And I will try really hard to not ever talk about market cap because it is a piece of crap.